I'm Ellie Perlman. I'm the founder and CEO of Blue Lake Capital, and I've done over $1 billion in multifamily transactions, about 4,000 units across the US. And when I started, I actually had no connections in the industry. So I basically started from nothing, zero investors. I didn't know any investor besides one that can come in with me to buy deals. I have zero connections in the industry. I did not come from Wall Street. And I'm going to tell you something that actually many people are not going to tell you is that um, none of the success happened because I was the smartest person in a room. I actually wasn't. And if you go to a top school, you're going to be very humbled and understand that you're not the smartest person in a room, which is exactly what happened to me. My success came because of a few things that I picked up along the way when I attended MIT as an MBA student years ago, actually 10 years ago. Next week, I'm going to the 10-year reunion, so that's very exciting. But the things that I learned at MIT, I I didn't see it. I didn't see those lessons anywhere, and definitely not in Wall Street. And Wall Street is not going to teach you those lessons. So, Wall Street teaches you formulas. MIT teaches you how to think. And in business, and especially in real estate, when we're talking about buying real estate, buying apartments, operating them, improving real communities where people live, how you think is basically everything. And so today I'm going to share with you the lessons that I've learned. And it took me, years to really think about that and understand what I've taken and what I've implemented, and realize that those three lessons that I brought with me from MIT, they pretty much shaped every deal and many of the biggest decisions that I've made. Um, it was also there when I had hard conversations with partners, with investors, etc. So these are not theories. And yes, at MIT, we learned a lot of theories, but a lot of the things were essentially brought to us by the smartest brains in the world that came to teach us. Um, and some of what I'm going to share is also battle scars. Yes, I've had success, but there were also challenges along the way. Things did not come easy. They never have actually for my life. And one of the first, if not, I think it was the first episode that I've uploaded here was about my life and how I started. So maybe I'll repost it again. I know some people were kind of interested in hearing about my life story and my background. So maybe it would also give you some more context and inspire you. But if you go back to the lessons that I've learned, um, I think that, if you're investing in real estate or if you're thinking about it, I urge you to pay close attention because these lessons are the difference between people who've built real wealth and people who quit right before the breakthrough. And it doesn't matter if you're a business owner or you're an active real estate investor or a passive real estate investor. I think you would get a lot of value by sharing those lessons. So let's get into it. Let me start with the first, and I think the most important lesson that I've learned at MIT. When I was there, we studied other companies and businessmen a lot. We studied what they've done right, what they've done wrong from any kind of angle possible. So that would give us kind of future business owners, entrepreneurs, the tools and the way of thinking of how things actually work from the other side. Because it's very easy to look at someone and think they're very successful, um, they're very well known or very wealthy, but the truth is so very different when you see things on the other side. And so, one of the things that I remember, one of the lessons that I've learned at MIT is that the most successful founders and companies, in the world went through a tremendous amount of pressure and failures. And I'm obsessed, by the way, with patterns. And I've seen that when I studied the most successful people in the world, they have failed. And failure is not that attractive. Maybe it's not also celebrated. or studied as much, but that's what we've learned at MIT. We didn't just learn how to build companies and scale from the most successful companies in the world, but also from those who have failed. And that's a very kind of interesting angle. Every single person that I know, that you probably know, um, have failed and a lot. They didn't fail once or twice. They repeatedly and painfully and publicly failed. And so, we all know the story about Steve Jobs. He got fired from his own company. He was fired by his own board. Um, and Howard, Schultz he was turned down by over 200 some investors right before Starbucks, got funded. And the last, 3 years in real estate, especially multifamily, have not been easy. And I've seen a lot of companies around me, a lot of people that started around the same time that I started about 10 years ago, they're not here anymore. This is not easy. This is not for the faint of heart. But the thing that kept me going was remembering, those lessons about how repeatedly the most successful people in the world have failed. And that's what separated them from others. They never let go and they never stopped, picked themselves back up and tried again and again. And so, when you're looking at those people, the common thread was not intelligence. Yes, some of them are very smart, but there's always someone smarter. And it was actually not connections. There's many people that come from wealthy families with, a pretty healthy book of connections, and their network is amazing. Um, but when you're looking at it, it's never the connections or the timing. It can get you so far, but grit is the number one lesson that I've learned at MIT. And I think personally, I've had that before I got to MIT. And if you know my life story of where I came from and how hard I fought to get to law school and then to business school, um, didn't always have money to even buy groceries or let alone pay rent. And my rent was about $200 a month. And I was struggling to pay that. I didn't really live in the best area in town, but when I went to MIT and I realized that that quality, the grit, is what the most successful people in the world had, that was fascinating to me. Um, and many people are there. We're kind of designed to avoid failure. Many times, when I moved to the US and then when I wanted to start the business, so many people around me, besides my partner, so many people around me said, "Don't do it. Go work for another company, get some experience. Don't move to the US, do something else. Tuition is crazy." It was about $200,000, which of course I took a huge loan to pay. We're kind of designed to avoid failure. And those who keep showing up, like my father-in-law, says, the best thing you can do is wake up and show up to work and keep doing what you're doing. It's the only thing you need to do. And what he meant by that is that's exactly the translation of grit. You got to get up in the morning and keep working and keep pushing forward. And this is not kind of a feel good, inspirational conversation. This is essentially what is separating success from failure and successful people from those who fail. And I definitely see that with multifamily. I see those who have raised money from investors and bought real estate. And when things got hard, and they did get hard, they just gave up. And when I say give up, it means that they haven't reached back to investors who are asking questions. Stop answering the bank. Stop answering, partners and partnerships falling apart. That's the lack of grit that I've seen around me. And even when things are hard and you cannot win on every investment, but showing up, being transparent, have that grit to keep fighting and keep pushing is what I want when I invest with other sponsors. And what I essentially want my investors to experience from me. Um, when I moved to the US, and that was maybe 12 years ago, I left behind a legal career, was a real estate attorney. I left my family, I left everyone and everything behind. And I really, I started from scratch. And after graduation, I didn't join a fund or a fancy tech company or a consulting firm. The path was paved for me after, graduating from a pretty well-known, respectable institution. I chose the hardest path, which is being in charge of paying myself the salary that I thought I deserved. Um, and when I started Blue Lake, it was from the my kitchen table. I had a little table that I bought, I think it was 50 or 70 bucks, with a little chair, and that was it. Um, and I've built my investors that, base over time. And I, it wasn't easy. And I did it one after another. And slowly I gathered a group of investors and we bought the first deal together. Um, and many people w would have quit at the beginning. Um, but I kept remembering the stories of the failure of those who have succeeded most in life. And those failures were huge and pretty much public. Um, so, but that's what I was taught at MIT. The grit isn't about just ignoring the pain, it's about using the pain. So every time I hear no from someone or I encounter some challenge, it's essentially, and I keep saying that I'm a challenge junkie, it's motivating me to figure it out, to find a way. And some days, gotta be honest, it's really hard, but I'm built in a way that I see the world as one big problem that I need to solve. And and that's how I'm trained to think, and MIT just made it even stronger. So, um, rejection is obviously part of it. Um, and when it comes to real estate, there were times where it was hard to find a deal because nothing made sense. That was a few years ago. And then when the debt increased and the burden on or on our cash flow was significant, that was another part that was extremely challenging. But that's the grit, not giving up and not raising, the hands in the air and say, this is bigger than me. I can't do it anymore. You know, the hell with it. I'm out. It's not even even a possibility in my book. So I think grit is something that was always part of me, and that's one of the best things that I've learned at MIT. Now, something else that I've learned at MIT is that you cannot live or die by a model, period. And I know that Wall Street worships, financial models. The more complicated the model, the fancier the model, the smarter the analyst, the better the deal, or the more professional the company is. And it's just incorrect. And I can tell you, as someone who came from the legal world, basically, modeling was not my natural affinity. And it took me time to learn that. And, at MIT, we also learned a lot of complicated models and formulas that started on one side of the board and ended on the other, um, including in real estate. And a lot of those models were very theoretical. But what I also learned is that models are designed to have some level of prediction. And that's what it is, prediction. And that there's a huge difference between what's happening in the model and what is actually happening in real life, or it could be. So you can look at a model and be extremely impressed, and the numbers look good, and everything seems fine. But if you don't go to the asset, if you don't walk it, if you don't sit there at 9 a.m., at 8 a.m., and look at the cars in the parking lot, drive around, see what is how the car, what kind of cars are there. The best assets I've bought were those assets that had BMWs and Audis in the parking lot. And the cars, even if it was Hondas, they were clean and well maintained. And that is a great reflection of who actually lives on site. And so the model can tell you a great story. You can push rents, you can decrease expenses and exit in year 4, year 5 with 18% IRR. All of that a model can do. And I can tell you a little bit of, a little secret. If you want to increase returns in the model, all you got to do sometimes is just push the rent growth by half a point, and you'll see what it does to the model. And this is something that sponsors are not going to tell you. It's very easy to manipulate a model. So you really have to have a discipline to know what you're comfortable with and what you're not comfortable with. And if the market is showing you that rents are not going up, then you don't underwrite growing rents or bump it up. The difference between 2 and 2.5% rent increase can be tremendous on the back end. And if you have a nice, fancy, very detailed model, but it doesn't go hand in hand with what's really happening in real life, then that's a problem. And so what I've learned at MIT is that many companies had great projections and the models were fantastic. But there were things that the model, that the spreadsheet could not see. So when it came to buying companies, for instance, the model could not see tension between senior leadership or the fact that the team was demoralized and a lot of them are going to quit in the next, 90 days. Or that there's another company that's going to compete with them and just take a big chunk of the market by surprise and all the valuation will go down. So some of those things the model cannot embed. And that's what I do when I buy assets. Take and hop on a plane, I go there and I sit and watch. I watch the type of people who go in and out. And I look at the cars. Of course, I go in and I do the formal tour and I walk the units, but then I also walk the neighborhood and I'm looking around and I'm paying attention to other things that are extremely important. For example, how does the commercial area nearby, how does it look like? Is it vacant? That's not a good sign. Is there a pawn shop? Not a great sign because it attracts a certain type of tenants that any model, as fancy as it is, no model is going to show you that. And so going there and seeing what's happening, what is the soul and of the community of that pocket, that's extremely important. There were countless cases where the model was great, and that's why I hopped on a plane and paid, $500, $700 on a plane ticket just to walk around and say, I don't want to own this. This is not the right area. This is not the right asset. And it's super important because many times it's detached from reality. So the model is a starting point. If things don't look good in the model, it's not going to look good in real life, but you cannot just live by a model. This is not a job like in Wall Street that many times is being done behind a desk, remote, and not in touch with what's going on. That's the second thing that I've learned at MIT. There are things that you cannot model, that you have to be there to feel and touch and smell in order to assess the opportunity. So model is just one piece of the investment, but it's not all of it, and it can be very, very misleading. So the third lesson that I've learned at MIT is that there's always a need in the market, and this is a very strong lesson. Um, Always a need that is not being addressed that you need to tap. You need to tap into that opportunity. We didn't really learn, MIT doesn't really teach you, okay, here's how you start a business. But it's more built around an interesting question. Here's how to identify a gap in the market that nobody else is addressing. Find that gap, build something that people need and don't have right now. That's very, very different than how Wall Street thinks. Wall Street teaches you to follow the money, but MIT teaches you to follow the need. And that's exactly what I do when I buy real estate. I've seen many cases where The business plan after sponsors bought an asset was detached from the need of the people who live on site. I've seen assets where owners put 20 to $25,000 on average to renovate one unit. Everyone wants to live in a nice unit, but tenants could not afford to pay for such a high-end renovation, not in that area. And the units were just sitting vacant and the owner was losing money. So they didn't identify any need. The need was for a decent unit, not a high-end A+ unit that the sponsor would have lived in. That was not the need that they just did not identify the right need. So what we do when we buy an apartment building, we study the competition, we study the tenant base and the population in the area, and we learn what kind of renovation they need. Some populations don't mind living in an apartment that a building that is slightly renovated but still has black appliances. And some tenants are sensitive to it and they want to live in a more modern environment, with modern finishes with stainless steel appliances. So you have to understand the need because if you're going to provide a solution that is essentially representing the wrong need or the right need, but to the wrong customer, the wrong tenants, it's just not going to work. And so studying the customers, which is the tenants that live there, learn what they need. If some of them are more sensitive to safety, then we will there's essentially a way to add more security. Um, these are smart thermostats that also go hand in hand, but a smart lock. And then we charge premium for it. But you have to understand what is the need? What is the need that no one else is also addressing and adjust to that in order to be competitive. So another example of outside of the box thinking is that in today's market, a lot of the sponsors are buying in the same markets, whether it's the Sun Belt or the Tri-State, and they stick to what they know and love. And when I'm looking at markets, we realize that actually sometimes the best markets are not the most well known or pockets that most people and investors don't focus on. And so one of those outside of the box thinking led us to look into a very interesting subsect that I'm very excited about, which is essentially the semiconductor corridors. So, the US AI is booming. We all know that. We all know that the current administration can hate it or love it, but they want to ensure that jobs remain in the US and that they are very much in favor of AI and growing that sector. And so the semiconductor industry is $500 billion industry, and there's $52 billion in government funds that are going and funneled to build those factories. Every factory hires 3 to 6 thousand people, not to mention all the other jobs and businesses that are related to semiconductors. So the CHIPS Act passed about 4 years ago, and the factories are now being built. And those pockets where essentially semiconductor factories are being built, this is what is going to drive the next demand. These people need a place to stay. So, yes, everyone loves Dallas, but what about an hour north of Plano, in Sherman, Texas, for instance, where there are semiconductor factories? Nobody's thinking about that submarket. That's the outside of the box thinking. Look at where the trends that are here to stay because it costs about $5 billion or more to build a factory. This is not a wave that is going to pass anytime soon. This is where the next demand for the next 20 to 30 years is going to happen. I'm looking at all the data and I'm convinced of that. So I'm following the demand before it becomes something that is very well known, but just looking at the numbers. And that's essentially what I've learned from MIT. One of the things that I've learned, that's the third lesson, to follow the demand, follow the need of the customer, not just follow the money and go and do what everyone else is doing. So that's it for today. That's we talked about three lessons, right? So we talked about grit. People who win, they're not necessarily the smartest. Not everyone is Elon Musk, and those who have grit are those that are simply refuse to stop. And sometimes it's stronger, more powerful, and essentially even more important than intelligence. So um, you know, those who show up at the worst day, those who keep going, who never give up on a portfolio or an asset, even if things go the other, go sideways, these are the people that will win. And that's the common thing that I've seen that we have been taught at MIT. That's the common theme of all successful people and companies in the US and in the world. The second thing is do not live or die. Do not overly rely on models. Wall Street, that's Wall Street's most powerful tool, but reality is a lot more complicated. You got to go and feel and see things that no model in the world can pick up. And then the last one is, of course, outside of the box thinking. The biggest opportunities are actually those that nobody's looking for. Go and serve that customer that nobody is serving. Go where no one else is going. Go to those corridors, to those pockets where you see the demand, but no one else is looking. This box, that corridor, that corner, that market is where everyone else is, where the demand is and where everyone else is essentially ignoring. And that's outside of the box thinking. So that's what MIT taught me. That's what $1 billion in real estate proved. And that's what Wall Street will never tell you. And that's what this show is going to be. I'm going to give you in every episode something real, something that you can actually use. I'm going to share what I see, the good, the bad, the ugly. Not everything is, of course, shiny and easy. And whether you invest with us or not, whether you invest in real estate or not, my goal is simple. As when you're done listening, you're going to get a little bit more educated, more, smarter about real estate and maybe learn, maybe take something from my life experience and my career as a founder and CEO and a real estate investor. I'll do my best to share the best insights and sometimes tell you things that other sponsors and other real estate owners and investors will not tell you and will never admit. That's it for today. I'll see you guys on the next show.